With all the banking turmoil, easy to forget that we're actually coming off the back of a week of gains on the S&P 500. On the Nasdaq as well. On the S&P, futures pushing on by 0.2%. The Nasdaq 100 last week up almost 6%. This morning, negative about 0.2%. Let's the opening bounce, switch at the board and get to the bond market. Another rally in treasuries, yield to lower by a couple of basis points on a 10-year, 340. A handful of basis points on a 2-year through much of this morning. On a 2-year right now in America, your yield comes in a couple of basis points on a 2-year right now, 3.81. Elsewhere, euro dollar positive a half of 1%, 107.22 to about 107 off the back of the moves we've seen from the Swiss authorities overnight. UBS positive by 3%. I'll come back to that story later. And crude down again by 0.7% to 66.29. About 30 seconds into the session, your equity market opens higher, positive on the S&P by a little more than 0.1%. One stock to watch at the open is First Republic. Shares extending record losses as the bank gets its second downgrade in a week. For more, Bloomberg's Kelly Lyons has more. Hey, Kelly.
Hey, John. Yeah, more pain for First Republic this morning. Right now at the opening bell, the stock down by about 19% after S&P Global Ratings cut the credit rating to B+ from double B+, which it was just cut to last Wednesday. The rating agency saying that the $30 billion in deposits it received from 11 larger banks last week in the form of an attempted, I say, rescue is not going to be a longer-term solution to this bank's funding troubles. They think it is going to have significant difficulty attracting deposits. This is the plight of regional banks in this moment after we saw the failures of Silicon Valley Bank and Signature Bank. So the question for First Republic is, where does it go next? Does it have to have another form of rescue, potentially a deal? Our up reporting here at Bloomberg, our understanding is that Tom Barrack, which is a member of First Republic's board, is playing a key role in talks to save it. In what form that savior comes, though, that is still an open question. Meanwhile, the pressure on the stock is continuing. The losses today add on to 81% declines over the last 2 weeks. This was a $122 stock 2 Mondays ago, John. On this Monday morning, it is trading at $19 a share.
Said the same thing a couple of times in the last 24 hours. Remarkable. Kaylee, thank you. Thank you for that. Elsewhere in the regionals, some big moves in the other direction. Abby has more. Hey, Abby.
Hey, John. Yeah, it's really pretty incredible because despite those continued woes for First Republic, we do have the regionals really putting together a rally today here on the morning. The KRE, that regional banking ETF, up more than 1%. And Western Alliance is really popping. B of A saying that their deposit trends appear to be stabilizing, so that's good news. And New York Community Bank Corp, that stock is up 36% on the open. It had been up 40%, a record open for that regional bank on the possibility that they are going to buy Signature Bank. You typically don't see the acquiring stock going up so much, but perhaps that's a proxy for Signature Bank since it was shuttered. Now, relative to the bigger banks, they are also rallying on the day. That's why we had this KBW Bank Index, which is a bit of a blend between the big banks, the money center banks such as JP Morgan, B of A, Citigroup, up 23%, being helped just a little bit this morning with those big banks up at this point up about 2% or so. The volatility, though, John, it's likely to stick around. But something important to remember, it could be to the upside or the downside. What we're looking at here in the top panel is the KRE and its implied volatility on a 10-day basis in yellow, popping sky high. Relative to the bottom panel, it's the same deal, but for the BKX. You can see that for the BKX, or that KBW Bank Index, that blended bank index, volatility flattening out. But for the regional banks, it's still going higher. But again, volatility can go back in both directions. So today we're seeing a bit of a mixture there.
Abby, thanks for that. Staying on top of the bank moves. We were staying on top of the bank moves through the whole weekend. The drama around Credit Suisse. UBS finally sealing a deal for around $3 billion. You might have been spooked if you woke up early this morning as a shareholder of UBS, down 16% at one point, positive almost 4.6% right now. Shanali Basak has more. Hey, Shanali.
John, you have to think about the coordinated responses you saw after the deal was announced. There are a lot of worries about UBS taking on this massive bank. However, you do have those assurances from the Swiss Central Bank that make it a little bit easier. It turns out every 10 to 15 years as we keep going through this, it gets easier for the central banks to respond. Now, I want to actually talk really quickly here about the COCOs here, the AT1 securities, because that's where a lot of the infighting was. The fact that they were wiped out, the fact here that the ECB has come out and said that common equity holders are really the first in line here to bear losses, stems some of the pains in the market that we saw
first need to go
investors
higher.
are starting to think a little bit long term, but remember, there is a lot of pain still under the surface. Other banks are still across Europe facing some downward pressure in their stocks, bonds as well. It is early days yet as we think about what this deal means for global markets.
The Bank of England's had to come out and address the same issue literally in the last couple of minutes. Shonali, what's changed for you after this weekend?
Counterparty risk. You have to think about the last couple of weeks and just how much pain the hedge fund community and the subsequent trading desks that banks have already felt. Banks have limits, John, on credit lines that can be extended to every client. Credit is tightening up with one globally systemic bank out of the picture here. There were a lot of people who stuck with Credit Suisse to make sure that they could still kind of have some firepower here. There are ripple effects that are beyond the obvious that will take some time to see how they'll feed into the market.
UBS up 5% right now. Shonali, tremendous work as always, thank you. Dan Iverson of PIMCO said it to us last week. Multi-month process. Not a couple of days, not a one-weekend solution. Got to work through a multi-month process here. I'm pleased to say that joining us now is David George of Baird, a constructive voice on the regionals. David, wonderful to catch up with you again, and thanks for being with us. You say regional banks offer the best risk-reward in years. Walk me through why, David.
Well, it's good morning, John. Hope you had a great weekend. Great to be on. We think that this is the best setup that we've seen since the financial crisis for the bank stock group. And the financial crisis was an actual crisis. This, in our view, is not a crisis. This is a couple of select institutions with very non-granular deposit bases, which really is the antithesis of most of the major banks that have very granular funding, very sticky funding. And I think over time, as the dust settles, the quality of these deposit franchises, especially for the larger regional banks, are going to shine through, and I think it's resulting in an epic opportunity on the long side.
David, if it is so idiosyncratic, why are mid-sized banks over the weekend asking the FDIC to insure all deposits for 2 years? Do you get the sense that maybe it might be worse?
It certainly could be. Look, there's a lot of panic, and when you see $40 billion move out of a bank in a day, it gets people's attention. And I'm sure there are a lot of clients are calling their banks thinking about what should they be doing with their liquidity. And I think a raising of the limit would probably stem some of that. So it's not particularly surprising. It wouldn't surprise me to see the FDIC take the limits up. But again, we're just in a period with a lot of panic, and we're trying to keep our heads cool and just look at the stocks and look at the valuations. And they really have not been more compelling than they are today, in our opinion.
Senator Warren was talking about 1 million, 2 million, 3 million. Do you have a number in mind, David, on what readdresses the issue?
It's a dangerous game to get into. I think 500 to 1 million would be a reasonable start and would probably stem a lot of these fears. Keep in mind, many commercial borrowers, as part of their contractual relationship with their bank, actually have to keep their operating accounts with their bank. So I just don't think, when we see bank earnings in a month, I just am not expecting meaningful deposit movement. We've seen a lot of deposit movement out of banks into higher yielding products over the last year or so, and I think that's ongoing and will continue. But I think when we see these results, this panic that everyone is worried about, I just don't expect that.
David, I don't know if you can speak directly to First Republic, but just to raise what's happening right now, we're down about 14%. You saw the move last week, 11 banks come together, 30 billion in deposit into the institution. Not enough to address it on Friday, down more than 30%. This phrase that got thrown around in Yellen's testimony last week, Secretary Yellen's testimony, a two-tier banking system. I think the public are latching onto that phrase, David. Do you see it as a two-tier banking system?
I can see where people, and I don't cover First Republic, so I can't talk about the stock.
Sure.
But I do see. I can see where that. I watch some of the Sunday shows, and unfortunately, I think a lot of the logic is flawed. Where First Republic is a little different. Again, I think a lot of this, John, revolves around granularity of funding. In other words, what is the average account size for a bank? In Silicon Valley, it was over 4 million. In I think First Republic's case, I think it's close to 1 million. For most banks, it's in the 50 to 100,000 range. So just a meaningful difference in funding. And I think that is really the big differentiating factor when you're thinking about the bank group broadly. And I just think that these issues, again, the idiosyncratic word has been thrown around a lot, but I think when this all kind of settles down, it's going to prove that these were really one-off situations that were not funded in a similar way that most banks are.
Well, David, appreciate your perspective, as always. Managed to catch up with you the last couple of weeks and looking forward to doing the same over the following few weeks as well. The S&P 500 just about positive by, let's call it, 0.25%. Daryl Cronk of Wells Fargo has this to say: it's still not a time to broadly buy equities. In the wake of current bank fallout, financial markets need more time to adjust to the reality of a weakening economy. There is likely more downside risk in stocks at this point. I'm pleased to say that Daryl joins us right now. Daryl, I'm sure you had the chance to listen to David George there, a much more constructive view on what's happening with banks. Where do you come down on this?
Yeah, good morning, John. So I still think the fundamentals don't line up and the technicals don't line up. We've talked about this on your show a couple times before. If you look at, you've only got less than a quarter of names in the S&P 500 above their 20-day, above their 50-day. We're at a lower percentage above the 200-day than we were back at the December lows when the indice was around 3750. So this is an old-fashioned gunfight at the OK Corral right now between the bulls and the bears. And the bulls are looking at it from cash-rich, balance sheets, things like technology, discretionary, and some of the comm services. And the bears latched on to, of course, banks and financials, energy, REITs, and healthcare right now, and they're both fighting it out very hard to see who's going to win. We're still below the 200-day moving average. That's, as I said in my notes, that's where accidents happen typically. So I think the preponderance of evidence still suggests there's probably more downside here than upside.
Daryl, at the end of the day, I don't think this comes down to what I think you think. David George was on moments ago giving a really constructive view of things. There's an analyst really in the weeds, knows his numbers. I'm not sure the public sees it that way, Daryl. They're not looking at it at that level. They're just saying, okay, what's the name of my bank? Is that systemically important? I'm not sure. I'm going to open an account with B of A, JP Morgan, Citi, take your pick. Daryl, how do we resolve that?
Yeah, I think, look, we've jolted depositors here, right, and injured their psyche a little bit, and so they're going to naturally react to that, and we're seeing it in some of the flow and everything else. So I think that will settle down, to be honest, John, at some point. I don't disagree with the prior speaker saying, look, this is a little bit, when you get into banking crises, they're almost always about confidence and liquidity and maybe less about valuation and asset levels. That's true of today's level. I do think what I called this was a little bit of an echo crisis, which tends to be a rolling echo from one epicenter to the next, right? We've seen it from some of the banks into the global banks. I think there's another role here. I think people, when you look at the CFTC data on short positions on the 2-year Treasury, that people scrambled like crazy last week to cover, and you had a 13 standard deviation move in the U.S. Treasury 2-year note, which should never happen statistically. There's some people that got hurt by that, right?
Yeah.
And I don't think that news is out there yet.
It's a massive move. Let's be clear about that. The 2-year was north of 5%. It's comfortably south of 4 now at 386.
That's right.
One place, Daryl, we've seen real outperformance off the back of that move in the bond market is the NASDAQ. Do you think mega cap tech is immune to the difficulties that we're discussing?
No, I don't think it's immune, but you go back to that fight again. What you've seen is not just mega cap tech, John, but you've seen a flight to quality here lately. I mean, bonds have rallied, gold has rallied. Some would call cryptocurrencies as a flight to quality rally or away from kind of the traditional risk and the epicenter of where it is. And you've seen those cash-rich balance sheets, particularly in the tech sector, really be a place that people perceive as a place to hide. I think they are in the near term, and we actually like tech. We've been favorable on tech for some time, and we like what's happened year to date. I mean, most people don't realize the tech sector is up 11-12% year to date, besting the S&P by over 1,000 basis points. So there's big moves that are happening there, but I don't know that I'd call them immune, because I think that would be a faulty statement.
Daryl, wonderful to get your thoughts. What a weekend. Let's just hope we're not doing that this coming weekend again. Daryl Cronk there on the latest. I think we all suspect maybe we might be, and we're all hoping we won't be. Equities right now up 0.2% on the S&P. On the NASDAQ, we're down about 0.5%. Coming up, Senator Warren playing the blame game.
Jerome Powell just literally took a flamethrower to these regulations in order to make them less and less effective.
that conversation up next.
Alright, this is the area where you would be entering. Okay, more than likely, we're not going at 395 today. Sorry, but we're not going up there.
$69 US Special Forces device turns men into beasts. It emulates 54,000 crunches in 20 minutes and
deposit account that there is zero interest, a checking account, and you're putting it into a CD or a savings account. And so it's the bank, the money stays there, it just has to pay more for it. So it's a bank profitability issue, not a bank liquidity issue.
Yeah. Yes. Yeah. People, there may not be deposits going out of the bank, but bank have to pay a significantly higher interest rate on the deposits that they have now as they reprice it. So compression in net interest margin is going to be hard and fast and large. Completely opposite of what analysts were expecting last year, that banks will actually make more by interest rate increase. So that's a profitability issue. But there is another piece to it, which is there is an attractive outlet for depositors that wasn't there before. That money can leave the banking system altogether and go to the Fed, because Fed's got a almost $2.5 trillion reverse repo program, which gives you full, fair, short-term interest rate to a depositor. So I can just go take my money out, put in a money market fund that invests in Fed's overnight reverse repo, risk-free. I fully reprice the new Fed fund, new interest rates in the Fed. So Fed itself put a program that will compete for deposits with the banking system. So on the one side, it will guarantee the deposit. On the other side, they're going to compete with the banking system. So it's not necessarily just from one bank to the other, or within one bank from low interest rate to high interest rate. So, but it's also some people exit the banking system.
The Federal Reserve Bank and Jerome Powell are ultimately responsible for the oversight and supervision of these banks. Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason. Jerome Powell just literally took a flamethrower to these regulations in order to make them less and less effective.
I'm not sure Jerome Powell actually said that, but that's a conversation for another day, perhaps if Senator Warren comes on this program again. Senator Warren pointed the finger at the Fed chairman amid turmoil across the banking sector. This coming as Powell prepares to deliver the Fed's next decision on Wednesday. With us, AMH down in Washington, Mike McKee here in New York. Anne-Marie, I imagine you're not surprised by how this has played out over the weekend.
No, absolutely not, especially from the likes of Senator Elizabeth Warren. Remember, she opposed Powell's renomination. She called him a dangerous man during that hearing in September 2021. And now she is really pointing the blame at the Fed. And not just Jerome Powell. On Face the Nation, she was also asked about if she has confidence in Mary Daly, the head of the San Francisco Fed, and she said she doesn't. The other conversation from Elizabeth Warren, the senator of Massachusetts, over the weekend, Jonathan, was how she said that she would be in favor of lifting this FDIC FDIC insurance threshold. The question is as to how high. And the backdrop to that conversation is the fact that you have a coalition of these mid-sized banks asking regulators to do just that, lift that insurance threshold for the next 2 years, because they say this would stabilize some of this exodus, the deposits they're having out of these small regional banks into the bigger banks. But so far, Jonathan, right now, this is just a debate.
I can hear the sound of silence coming from behind you. The White House. Anne-Marie, where are they on this?
Well, it was interesting because over the weekend there was one statement from the Treasury and the Fed, and that statement had 3 sentences, just that they were working with their international partners. Of course, this has to do with what happened in Zurich regarding UBS's takeover of Credit Suisse, and that the fact that they say that the banking situation in America, that they see that the U.S. has a resolute banking situation. So a very small statement. What we do know from behind the scenes and reporting by my colleagues over the weekend is that actually last week you had Jamie Dimon sitting down with Treasury Secretary Janet Yellen. This weekend it was potentially more calls with Warren Buffett. This is one individual that could potentially get involved in shoring up some of these regional mid-sized banks, but also just looking to him for his knowledge and expertise and experience he's had with the banking situation. But nothing out publicly, Jonathan. All these conversations are happening behind closed doors.
Mike McKee, the Fed under the spotlight this week for more reasons than one.
Well, I'm not sure about whether he's paying any attention to the political carping in Washington, because that goes with the job. But he has to worry about what's going on in the markets, and he has to worry about what's going on, even more than that, with American business. There is a new pessimism out there, and it's come from many of the people that you have been interviewing all today and yesterday. The story goes like this. Cumulative rate increases are going to choke off demand anyway. Smaller banks are now going to raise deposit rates to keep business. That will lead to tighter lending standards, and the flow of credit will slow significantly, and that's why we get a recession. Well, we'll keep an eye on it, but right now that doesn't seem to be the actuality. If you look at financial conditions since SVB went down, they have gotten looser or basically unchanged. We are seeing Treasury yields, as you've reported, go down, 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 and that is helping keep financial conditions looser. So if the Fed wants to fight inflation, that's something they have to keep in mind. The story about banks pulling back on lending standards, well, here's what's happened recently. This is only every month from the Fed, but you take a look at this and you can see that banks have tightened somewhat since the first of the year, but all this was before the SVB crash. This tightening significantly has almost not changed at all. So far, we are not seeing the evidence that people have been talking about, and I thought a kind of interesting note this morning, John. Well, I had talked yesterday about that swap lines going out from the Fed and other central banks. The total amount of dollars requested was $5 million from the ECB. Nothing from Switzerland, nothing from England, nothing from Japan. So it doesn't look like there's dollar funding stress yet.
Mike McKee, yet. Let's hope there won't be. Mike, thank you for that. AMH, thank you as well. Down in Washington, about 22 minutes into the session, positive 0.4% with some sector price action. Back with us. Here's Abby.
Well, John, we do have that S&P 500 up a little bit on above average volume. The best sector, interestingly, materials up more than 1% for no particular reason, just broad-based strength for those stocks. Financials up 1.5%. JP Morgan, Bank of America, Citi, all up more than 2%. We also have First Republic off of its lows, down about 12%. And we also have news that Signature Bank has sent a letter to clients on that merger with New York Bancorp. Here's that Haven trade, though, that you and Daryl Cronk were talking about. Tech and crypto. It makes no sense to me, but there it is, John. Big gains over the last week.
Abby, thanks for that. Your trading diary up next. Chairman Powell, just a few days away.
Apple's not looking too hot. And if that's the case, that means this whole fucking move is going to get reversed. Because if Apple starts going lower, this is going to start going lower. If both of them are starting to go lower, this fucking move right here is all bullshit. However, let's find out. Let's see what the others are doing. Amazon's not looking too hot. Microsoft is not looking too hot. I will say you are kind of balanced right there. Google's about to get balanced. VXX. This is kind of balanced, but it's not holding too well. Meta's already under. Where's Meta? Out of all of them, Meta's the weakest. Out of all of them, Meta's the weakest. So I'm gonna wait on a pop for this.
Like Bloomberg.
So far, so good. 25 minutes in, up a third of 1% on the S&P. Last week, big week of gains on the Nasdaq. We take some of that back. We're down about 3/4 of 1% on the Nasdaq 100. Some relief for the regionals, the banks. That's given the Russell a little bit of a lift, up by more than 1%. That's the price action. Let's get to the trading diary. ECB President Christine Lagarde speaks at the top of the hour on Wednesday. The main event, a Fed rate decision and Chairman Powell news conference. Plus, Secretary Yellen heading to Capitol Hill once again. Rate decision from the BOE, the Swiss National Bank, all coming on Thursday, along with another round of jobless claims as well in the US. And finally, rounding out the week with durable goods and PMIs on Friday. Looking ahead to Chairman Powell. A lot of people looking for 25, looking for a pause. Barclays, Credit Suisse, Goldman looking for a cut still. Nomura. More coverage still to come this week from New York. This was the countdown to the open. This is Bloomberg.
That way you can add to it.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Monday, March 20th. Here are the top market stories that we're following for you at this hour. It's the First Republic fallout. S&P cutting the bank's rating again, warning its $30 billion rescue deal just won't be enough. The stock plummets yet again. And debt versus equity, who should bear the brunt? Credit Suisse's risky bondholders rail against their $17 billion loss. Gunlock tells them to put on their big boy pants. Who bears the real risk? Are we there yet? Are we there yet? Markets and bonds stabilize. Most regional banks rally, and New York Community Bank's parent buys Signature's deposits. We try to find out if the banking crisis is over. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, to help answer the question, I want to know what asset I should be looking at. When I was watching futures open last night at 6 p.m., I was like, what do I look at to tell me if everything's okay?
It's a really good question. How do you quantify confidence? I think that is the question that the market is grappling with right now. But you just run through kind of what is happening and you just give us a really good summary. Take a look at what is happening with UBS. It's tracking higher today. Is that a sign that the Credit Suisse story is tied off for now? The New York Bancorp story on Signature, I think, is really interesting. Is that a model for what we're going to see with some of the other regional banks? Do we have a way through this? I still think there's some really big unanswered questions. Why are different regulators treating this crisis differently in the way that they're approaching it? I thought they were all meant to be on the same page post GFC. That is not happening, and that's going to create some gaps, which I don't think the global banking industry needs right now.
Well, also to that point, banks, in terms of their cost of capital, it's going to go up. We talked about that last week, and now we see with the AT1s and the COCOs, like that's definitely going to go up now. Where is it going to go up the most? How do we quantify that? How do you put that into a banking model? I mean, yes, it's not today's story, but it's going to be the next 6 months, 3 month story, so we're going to talk about that as well.
It's going to take a long time to unwind all of this. Christine Lagarde is giving testimony in front of the European Parliament now, the president of the ECB. Inflation is projected to remain too high for too long. She's repeating that line from the press conference where the ECB raised by 50 basis points. The interest rates remain our primary tool. Future ECB moves depend on data. She is reiterating to the European Parliament, Alex, what she said last week, but it does set us up for the question. And I do wonder whether or not to try and answer the question on do we still have a banking crisis, we have to wait for Wednesday. The Fed, in theory, knows more about what is happening with the financial system than the rest of us. So if the Fed pauses, does that signal that we have a problem? Okay, let's try and answer the question with better minds than Alex and mine. We're joined now by Bloomberg's Sonali Basak in New York, and Bloomberg Surveillance Early Edition anchor Francine Lacqua, who's been doing fantastic work in Zurich and Bern over the weekend. Fran, I'm going to come to you first of all in Zurich. UBS is trading higher. It gapped lower first thing this morning, and it's been tracking higher since then. Is the Credit Suisse crisis now over?
No.
Well, it seems that it's certainly not as over as many would have liked it this morning, but it's a lot better. Now, a couple of questions, Guy, good afternoon to you, that we really need to answer. First of all, why did the stock drop this morning by so much? And still, we don't have answered questions. First of all, did they see something in Credit Suisse that actually freaked them out, which is why they needed all this collateral and loans and everything like that? That's still an unanswered question. Market, I guess, takes solace with the fact that they now seem very blockbuster in terms of infecting UBS. But actually, what does this bank become? So it's the master bank. Does it break off? Does it sell off units? What happens, of course, to the Credit Suisse First Boston branch? So we don't 100% know where this ends up. I think there was initial panic reaction this morning, also about all the questions about AT1s and things like that. Maybe now we found a floor, but I think the next couple of days, as we have more details about the deal, as we have more details about the banking system as a whole, and actually what UBS intends to do with this bank, that's when those come out that we'll see whether the banking crisis is well and truly behind us.
Yeah, and I've been reading a lot, Francine, about how, you know, the bigger the bank gets, the harder it is to not take risk. So the bigger you are in general, you just have more risk on your balance sheet. Hey, Sonali, does Wall Street think that the banking crisis is over?
It's certainly not over because there are too many unknowns to look forward to. So for example, when you look at the Credit Suisse crisis, what is the ripple effect of the European banking system? When you look at the United States, even if you have First Republic as a standalone worry at this very moment, there's another worry about what happens when, other banks face more pressures on their balance sheet, maybe see some tension on their deposits, but then there's another issue here that it goes beyond the initial crisis, which is the profitability question. I had somebody throw around this very kind of scary concept to me last night of this idea of zombie banking, where you're really worried about the profitability of these banks because now their cost of funding has dramatically risen. So there are a lot of unknowns, if you will. I think Jeffries put it in a very interesting way before even the Credit Suisse deal even happened, and it's this idea of when does a liquidity crunch turn into a credit crunch, and at what point those two overlap and you're dealing with both for a while.
Shidali, how much attention is Wall Street paying to what the Fed does this week, Wednesday? If the Fed goes 25, can Wall Street go, well, they know more than we do, and therefore they're comfortable with what is happening here and are still comfortable raising rates? How big a litmus test is that for Wall Street? Or does Wall Street think it's got a handle on what is happening here, or is it still looking for guidance?
There's no handle. How can there be a handle? Why, Guy? Because on one hand, you have the rate question, which is a very difficult one, and there are the other big questions around what does this amount to in terms of quantitative easing, in terms of the extraordinary support measures that have been made to the banking system in the last couple of weeks. That net effect has not been really calculated. There are some numbers out there on how it would amount to a rate hike that we've seen already and that they don't need to do more. The lagged effects of what we've already seen and whether the Fed is behind. You could debate this all day, every day, but at the end of the day, we are still dealing with an inflationary environment that is still a headwind to markets as well. You made this point to me in the commercial break that I think is worth getting at, which is the idea that the central banks here that we're looking at are not necessarily in coordination all the time. So when we're looking at all the trades that are being unwound now, you just think about the buy side for a second here in the last 3 weeks and how much pain they've felt. Is pretty stunning. There is a little bit of good news here. Remember, a lot of those trades really hit on currencies, on macro, on interest rates. But if you look at, for example, Bob Elliott of Unlimited Funds, he sees an end in sight despite the pain we've seen over the last couple of weeks. Guys, bank earnings is just a couple of weeks away. Oh, yeah. And so, we have a lot of unanswered questions here about money flows, about money lost, and about the real pain that's being felt under the surface.
That's right. And, Francine Shine makes a good point. And the BOE said this earlier today, that its A1 instruments rank ahead of some of their other instruments. So there is confusion as to what ranks where. But then Gunlock says, put your big boy pants on. Francine, what are you hearing on the ground?
Absolutely, and I think to Guy's great point at the beginning is that actually we're meant to have regulators looking at this so that everyone was treated the same in all jurisdictions, and it doesn't seem the case. Now, more than a credit crisis, I would look for a funding crisis. So if a lot of banks say, look, I'm not sure what to do with AT1 at the moment because I don't know if people will pick them up, what does it mean for future growth? What does it mean for revenue? And actually, again, what we are waiting to find out is the kind of panic that led to this buyout of Credit Suisse. Was it tens of billions of more of deposits and outflows that we saw Thursday and Friday? Because if they weren't that big, then what exactly was the necessary, the really underlying reason for this hastily takeover target where also UBS said they didn't really have that much time to do due diligence? Was it really just market fear? And if that's the case, market fear and actually investors panicking could hit anyone else.
Right. Market fear as a reason for M&A. I mean, there's a real problem, a real question, and that's exactly how we don't know yet if the banking crisis is over. Where do we look for that? Guys, thanks a lot. Francine, you got to catch a plane. Thank you for joining us. Francine Lacqua and Shillelagh Bassig is running down to report on Credit Suisse. More there. All right, coming up, more of the question of the day. Do we still have a banking crisis? Ian Harnett, Absolute Strategy Research Chief Investment Strategist, will be weighing in next. This is Bloomberg.
It is overextended. It is overextended. And if for some reason at some point we go through that high, then we know that's not the top. We go through that high, then we know that's not the top, and the process continues, and the process continues, and the process continues. To set up on Microsoft, yeah. We need to go through that, but we're already at a spot here. We're $10 away, more than likely. Right.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room, looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
So, the ECB President, Christine Lagarde, currently giving testimony before the Committee on Economic and Monetary Affairs at the European Parliament. This is taking place in Brussels. The line she's come out with in her opening statement thus far look very similar to what was delivered last Thursday. Let's take the temperature of what is happening here, because obviously this comes after the weekend when we've seen the UBS Credit Suisse deal put together. Maria Tadeo is there for us. Maria, the statement looks fairly similar. Any differences? What kind of questions do you think she's going to get?
Well, not for the statement, Guy, because there's one thing we should make clear. What we see today with Madame Lagarde at the European Parliament, it's not exceptional, and it's not a response to the UBS deal and Credit Suisse that happened yesterday. This was on the agenda. This happens regularly, and there's this Q&A that happens with members of the European Parliament. So that statement is usually very similar to what she says at the Governing Council decision, where, remember, last week she said when they hiked 50 basis points, she did not see a trade-off between price stability and financial stability, essentially that they could handle both. And a lot of contacts that I spoke to after that press conference actually told me, you know what, this was one of her best press conferences. The message was clear. The problem for Madame Lagarde today is that on a Monday, 4 days later, she has to go back to square one to say, no, we do not have an issue, systemic problem with European banks. Yes, we need to obviously instill a message of confidence, but to some extent, it's just having to go back to square one to prop up a market that, you know, opened up this morning, with a lot of doubts.
Right, and I have to point out that she also mentioned in the statement that market tensions add uncertainty to the forecast, Maria. For a market that was used to a very strong signal from the ECB, we are going to hike 50 bips in March, having that now uncertainty has got to be very difficult. And I'm wondering what kind of questioning you think we're going to get along that line.
Well, in terms of the forward guidance, if you look at that decision on Thursday, she made it clear that forward guidance is gone for the time being. And she was very candid. You know, I was there in that press conference in Frankfurt, and she just said, given the volatility, and arguably you could argue there was less that day, it's hard to tell what's coming down the road. And again, this is going to be data dependent, meeting by meeting, and there was no reference to the main meeting. There was no reference to any basis points whatsoever. So that is going to be the point and the line the bank is going to stick on. I think the issue now that we're going to hear, and I guess a lot of the questions will now be forward-looking on that, is whether that contagion risk has been solved, whether there are systemic issues when it comes to European banks. And of course, when you look at the situation with the ET1s, there was that statement from the European regulator, pretty aggressive, saying we have a way of doing things and there's a hierarchy, you've got to respect it.
Yep, big boy pants, like Unlock said. Maria, thanks a lot. Bloomberg's Maria Tadeo joining us there. Great reporting. All right, for more on the question of the day, do we still have a banking crisis? Interpreting the last week has been extremely difficult. You need to know that if you know how to invest. Ian Harnett, Absolute Strategy Research Chief Investment Strategist, joins us now. Do we still have a banking crisis?
Yeah, I think we certainly do, Alex, and I think that it's not going to finish for some time. You know, we've coined this phrase quantitative destruction, whereby we believe that, you know, what you're seeing with that, the interest rate rises that we've had over the last year or so, plus the rundown in the central bank balance sheets until the last couple of weeks, you know, is a systemic shift, that we're undermining the institutions and structures that thrived and originated in the last decade of zero interest rates and easy liquidity. And the adjustment process is profound, and we've seen it already in some of the US institutions that have come under pressure and failed, and now we're seeing it moving into the European. And we think this is closer to the beginning than the end, and that's going to be a problem for markets.
Ian, good morning.
Guy.
Can I own bank stock? Can I own bank credits? What do I do if I do that? If I hold that now, do I continue to hold it? What do you think about investing in financials right now, that particular sector?
Well, our head of equity strategy would still say stay maximum underweight. We believe that equity markets have got a long way to go down. We're talking about 3,200 for the S&P, which would only be 200 on the earnings numbers and 16 times, which is a very reasonable historic figure. But the areas where the earnings are going to see the most adjustment are still the bank stocks and also the energy stocks. So these are the real fulcrum points of where the weaknesses are. And that's also going to become more of a credit crisis as well, guys. So you want to stay clear both on the credit side and on the stock side.
But if you had told me a month ago that we would have had multiple banks fail in the U.S. and UBS buying Credit Suisse and the S&P was at its 200-day moving average, I would have told you were crazy. Like, we had the quote-unquote worst-case scenario happen, and stocks are holding up.
Yeah, so crisis, what crisis? And I think that's what's going to inform. I think that's what informed the ECB last week when they raised rates, and I think it's going to be what informs the Fed this week. So we do not think that the central banks will be disrupted from their rate rising profile about getting inflation down. That is their prime objective. That is their mandate until we see enough weakness in these financials that unemployment starts to go up and that central banks can feel absolutely confident that core inflation is going to come down. And with the S&P at 35, still 3,900, back in October last year we got below 3,500. This isn't a crisis, Alex, and that's not going to influence policymakers from our view.
Okay, so just to come back to the question of the day, do we still have a banking crisis? Listening to what you just said, the Fed is still going to be comfortable with raising rates. I'm assuming, I don't know, what do you think, 25 this week?
Yep.
And if they do raise by 25 this week, Ian, can I assume that there is no financial crisis yet? We've got pockets of weakness, but no crisis.
And I think that's a fair description, which is that it's these pockets of weakness, Guy, that are just going to increase. At the moment, people are viewing these things as idiosyncratic risks. As I say, we view them as part of much more of a systemic crisis. And the lesson that we took away from both the GFC and also the Eurozone crisis is that systemic risk is multiplicative. It is not additive. It's not the big things that blow you up. It's these small things that start to unwind the structures of the market. And this time it's all been about the bit that grew most rapidly in QE. It's about alternatives, it's about VC, it's about also this mortgage lending, and that's one of the problems for First Republic, of course.
So where does it go next?
So we still think that it carries on, and this is one reason why I'd be still very concerned, Alex, about the European financials, because European housing is actually seeing house price deflation faster than in the GFC. Mortgage debt is weaker, and mortgage demand is weaker than it was in the GFC. Building permits have collapsed, and construction orders. But it's core Europe this time. It's not the periphery that's the crisis area. And this is why we're still very concerned, Guy, on those European financials.
Yeah, it's interesting, isn't it? Mortgage debt, etc., may be less of an issue in places like Italy, which was the epicenter of the action last time round. Ian, do I need to think more regionally? Do I actually need to put a geographical overlay on this? Because one of the things we've learned over the last few days is that US regulators, Swiss regulators, European regulators are treating this story differently. The US is guaranteeing all deposits. The Swiss are putting AT1s below equity in the capital stack. The Europeans are saying, no, we're not going to do that. how much of a geographical approach how much of a geographical overlay do you now need to put on the way you're thinking about your investments?
So I think we would still very definitely focus on that geographical overlay you've talked about, Guy. And so there's 2 points here. First of all, a lot of investors moved into Europe in that October to January rally. We think that is massively overdone, and the risk of recession and big earning declines there are still very prevalent. So we would definitely want to switch out of Europe, and we would go back towards the US, but also potentially, if you want some cyclicality, Asia, because that's China's got more discretion potentially. But what you also talk about here is regulatory arbitrage. And again, while you've got that lack of consistent view, that says to me we're still going to have a crisis, because until we get a consistent narrative and you have capitulation after a number of other bank or financial institution failures, and it will also be non-bank financials as well, by the way. They're the ones that are less well regulated. Then you start to get some realization. We get some better valuations. Remember that valuations, both in absolute terms and also relative to bonds, on our models, some of the valuations we're looking at on our detrended bond equity models, last time you saw those were in 2000. We're at that kind of extreme for equities versus bonds. 1929. We're talking about a once-in-a-generation opportunity to switch out of equities still into bonds.
Where in bonds?
Treasuries.
Like
and we would be saying at the moment you probably want to be in the belly of the curve. You've got some optionality there, but eventually it will be. The front end collapses, but that's probably not going to be until later in the year.
Do I want to get in now, or do you think the Fed hikes a little bit more and there's going to be a better opportunity? Do I need this immediate crisis to clear if I've got fresh money to work to put into the Treasury market?
So we have just gone max overweight on bonds as well as max underweight on equities, guys. So we would be making that move. But as I say, yes, the front end of the curve can go higher. Play the belly of the curve, play perhaps the 10 years as well. We certainly think that as headline inflation comes down, you're going to reconnect with some of the macro drivers like new orders, which would actually be pointing to, historically, it would have been pointing to something like 2.5% on US 10-year treasuries. So, that's the kind of scale of move that we see over the next 6 to 12 months.
Enjoy New York, Ian. Great to see you. Ian Harnett, Absolute Strategy Research Chief Investment Strategist. This is Bloomberg.
Yeah, I don't know about this Apple. It all comes down to Apple at this fucking point. Right, are they gonna fucking squeeze out here? Right, and that's probably what we're going to end up doing, is we're going to stay in this range today and tomorrow. Then we decide. Maybe we push and then fail, or come in and then... I will say there's a lot of doubt. There's a lot of doubt. Yeah. I mean, you want to start when it's overextended. Not okay. Apple also.
It's time for Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Starbucks says Laxman Narasimhan has assumed the role of Chief Executive Officer 2 weeks earlier than planned. Narasimhan began working at the coffee giant in October and spent the last few months getting to know operations at more than 30 stores and other facilities. He's replacing Starbucks founder Howard Schultz, who had been interim CEO since April. A group representing Uber, Lyft, and other app-based services is raising concerns about President Biden's choice to head the Labor Department. The issue is over Julie Su's stance on worker classification rules. The group wants Sue to explain how she would implement a rule that could make it easier for workers to be considered employees rather than independent contractors. And Volkswagen is planning an even cheaper electric vehicle. VW brand chief Thomas Schaefer told a German magazine there could be a model selling for less than $22,000 as early as 2026. Now, last week, VW unveiled an EV that will sell for less than $27,000 when it reaches showrooms in 2025. And that's your Bloomberg Business Flash. Guy?
Lisa, thanks very much indeed. We've got Christine Lagarde speaking in front of the European Parliament. She's just kind of getting to the end of her prepared remarks. These are very similar remarks to the ones that were delivered at the press conference in the opening statement that she delivered there last Thursday. But Alex, she's having once again to push back on this idea, which the UK authorities are doing as well. The EU and the UK are basically saying AT1s are senior to equity in the capital stack. The Europeans, the ECB was quite cross with the US regulators for guaranteeing all those deposits when it came to SVB. These regulators are not on the same page.
No, and then if you're an investor, just straight up say a bank investor, what do you do with that? Like, how do you know how to invest in a bank if that's the case? Plus, if you're the CFO of a bank, how do you know where to raise money now and in what part of the capital structure?
Yeah, the whole idea was coming out of GFC that they would all be on the same page. First contact with the banking crisis. That blows up. Anyway, you're looking at pictures coming from the Parliament. This is Bloomberg.
And just like that, dude. Just like that. $5 away.
about an hour into U.S. trading session. It seems to be that equities are holding in. Tech is trading a little softer, but steady as she goes. Abigail Dildal's tracking the moves. Abby?
Yeah, and Alex, it's interesting because we have this divergence here where we have the S&P 500 and the Dow up more than tech, which is down to your point. And this has to do with strength of the materials, the industrials, and the financials, some of those big banks and some of the other stocks. Caterpillar up more than 2%. On the other hand, we have the NASDAQ 100 down about 0.3%. Not a huge deal to the lower. And the New York Bank Index, some of the mega cap stocks, tech stocks, down even more, down about 1%. As for the regional banks, well, we have a bit of a rally here on the day, a little bit of a comeback. This is a two-day chart to show the pop on the day. We're looking at a gain of 4.4%. Now, First Republic is down and another downgrade by S&P deeper into junk, but we have the likes of Western Alliance and Pacific West. We also have New York Community Bank soaring at the open. It had been up 40%, a record gain on the news that they are going to be basically rescuing, buying Signature Bank, which apparently on Monday will be open for as normal. Here's the divergence, though, between some of those big banks, JP Morgan and Bank of America, both up about 2%. Then take a look at Microsoft and Amazon down more than 2%. It's not entirely clear what this is to the downside for tech. It could just be a bit of consolidation because, of course, last week, the NASDAQ 100, its best week since November of last year. In fact, let's put all of this together. On the year, what we're looking at is a pretty solid rally for the NASDAQ 100 up about 14%, the S&P 500 up about 2.6%, and then the banks, the KBW Bank Index down about 8%, and the regional banking index, or that ETF KRE, down closer to 20%. So, Guy, it really does appear, relative to your question of the day, is there a crisis in banking? Will it last? It seems pretty isolated at this point. If this divergence continues, again, it seems pretty isolated.
It's interesting, regional banks started to track a little bit higher, obviously with one exception. You've got UBS tracking higher as well. Maybe it did get a good deal. Maybe we can tie that one off. Abigail, thank you very much indeed. Abigail perfectly brings us back to our question of the day. Do we still have a banking crisis this Monday morning? Andrew Leish, Piper Sandler, senior research analyst, has got a neutral rating on Republic. So let's talk about where we are this Monday morning. Andrew, let me come to you with our question. Do we have a banking crisis this morning, or do we just have a problem with one bank?
Well, I think what we've seen is more problems than just a handful of banks, just a few banks that had more concentrated deposit bases rather than what you might find at your local community bank or even other regionals that have a lot more retail deposits or are much more business focused and have a much broader deposit base than what you might have seen at First Republic or Signature.
Why can't First Republic stabilize?
Well, I think there's still some questions on the deposit trends. I was hoping that the $30 billion consortium of deposits that came in on Thursday would help that a little bit. As the news reports have been, they've reported, they've lost about $70 billion of deposits. Last week, $30 billion came in, and I guess there's still some concerns that more deposits are outflowing, even though the company has said that they expect it, or that they're seeing daily deposit flows really slow.
Do you think if the regulator said, you know what, we've got this, we're going to protect depositors, how would that change the narrative?
Well, I think it would certainly help, and maybe it helps retain deposits at the bank and alleviate any concerns. I'm not sure how long they'd be able to do that, and that would take an act of Congress to guarantee all deposits. Maybe there could be some sort of short-term fix they could have out there, but which would certainly help. But right now, they stopped short of fully guaranteeing all deposits.
Yeah, I know that a lot of regionals want them to fully insure all deposits for all the regionals for 2 years. Do you think something like that is at some point realistic?
I'm not sure, because then you get down a slippery slope, like how far do you want to go on guaranteeing every single deposit in the banking system, and so I'm not sure if that is something that's realistic. And again, you would need an act of Congress, I think, even to go out that far.
So what is the next step here? Do you think we get some sort of a private deal being put together? Do you think you could potentially see a merger with another institution? Obviously, the big banks are heavily limited in what they can do at this point. What kind of a deal what kind of a deal structure, and who would take the other side? What kind of a kind of story could we be talking about here? What would make sense, Andrew?
Certainly. Long term, there's a lot of value in this franchise. Right now, one of the hindrances to the deal would be fair marking the held maturity portfolio and the loan book for the interest rate environment that we're in, which makes it a lot tougher to get a whole bank deal done. Now, there have also been rumors that they're out there trying to raise private capital, but unfortunately, we're just kind of in a wait and see mode right now to see how that might come together. Like I said, there's tremendous long-term value in this organization, and to the extent that interest rates are lower in the future, the value of those mortgages and the value of the held-to-maturity securities would be more valuable as time goes on, and so there'd be certainly some nice accretion to whatever bank would be acquiring the franchise.
Let's go to cost of capital, Andrew. All across the board, is the cost of capital for banks just going to go up? And if so, how do you then model which banks make good value right now?
Oh, for sure. And you just look at the earnings outlook for the industry. You're going to end up with higher deposit costs industry-wide. That's probably going to curtail credit and demand or credit availability. And then longer term, more regulations are going to flow down to smaller banks. Right now, a lot of the regulation is focused on banks $250 billion and larger. I fully expect that's going to be banks maybe down to $10 billion are going to be forced to endure with more difficult, more stringent regulations. And that's just going to make the earnings environment a lot weaker for the industry. And then so it'll be the returns aren't going to be as good, and so the cost of credit will go up. And so right now it's kind of a fluid situation. A lot of banks are going to do really well throughout all this. The banks that do have the best deposit bases, I think, are going to be some of the winners in the long term. But right now we're kind of in a transition period as we kind of work through what are the long-term ramifications of this to the vast majority of the industry. And I would just point out the vast majority of the industry is very healthy. As we noted earlier, it's really just a few deposit bases that a little more concentrated that you might find elsewhere that we're seeing these questions.
Andrew, we've got a whole series of regulators blaming each other for what is happening here. The Swiss blamed the US and the instability we're seeing in the regional banks for what just happened with Credit Suisse. The Swiss decided to put AT1s below equity in terms of the stack. We've got the European Central Bank pushing back on that. The UK is pushing back on that as well. There's also been criticism of US regulators for guaranteeing deposits at SVB. What do you make of what is happening with regulation right now? Different countries, different regions seem to be going their own way. I thought post-GFC they were all meant to be on the same page.
That was the thinking. Maybe they have to have more conversations and get back to the table and try to iron out more issues on a global basis, especially for the larger banks. But I also remember the larger banks do have a lot more regulation globally than these smaller ones. And so somebody like a First Republic may not need any regulation globally or in other countries. It's more of a U.S. regulation
Andrew,
topic.
Before we let you go, what's the bank to buy in a dip right now?
The banks that I like the most right now are the ones that have the best deposit bases and the best credit quality. I got to go down market cap right now, and the ones that I expect are going to do the best during the downturn, somebody like a Banner Corporation or Enterprise Financial Services Corp, two mid caps that I cover that just check all the boxes for managing through a downturn and with a challenging liquidity environment.
Cool. All right, Andrew, thanks a lot. Andrew Liesch, Piper Sandler Senior Research Analyst. Really appreciate that. So coming up, we're going to look at managing the systemic risk from the banking crisis here in Europe and here in the U.S. I'm in the U.S. Guys in Europe. Here in the U.S. and in Europe, we're going to speak to someone who's dealt with Iceland's banking crisis. Sigga Benediktsdóttir of Yale University is next. This is Bloomberg.
I don't like what it's doing. I will say that. a seller here. Right. Here's someone selling.
Keeping you up to date with news from around the world. Here's the first word. I'm Lisa Mateo. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. The 3-day trip is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending the war. That plan has been dismissed by most Western governments. In the UK, 20,000 members of the RMT union have voted to accept a new contract and end their dispute with Network Rail. Workers staged a number of strikes over the last 6 months to underscore their demand for higher pay and better conditions. And a unit of New York Community Bancorp has taken over Signature Bank's deposits and some of its loans. Signature collapsed earlier this month. Its 40 branches will operate as locations of Flagstar Bank starting today. As part of the deal, the FDIC gets equity appreciation rights in New York Community Bancorp, common stock valued at up to $300 million. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
All right, Lisa, thanks a lot. Let's get more in the banking turmoil. Siga Benedictadar, Assistant Dean of Undergraduate Studies at Yale's Jackson School of Global Affairs, joins us now. She was former director of the Financial Stability Department at the Central Bank of Iceland and was also an economist for the Fed. Siga, our question of the day is, do we still have a banking crisis? A lot has unfolded in the last 2 weeks. What's your take?
Right.
I think that the Swiss authorities moved swiftly over the weekend and came with a solution that was quite important for this developing story. And the takeover of UBS or Credit Suisse will hopefully stop this kind of amplification of risks and in the banking sector. So I don't think that these two issues, the U.S. banking failure and Credit Suisse, are that connected. Credit Suisse has been dealing with a lot of issues, in particular end of last year, in the fourth quarter, where they lost almost 40% of the deposit base in 2022, and most of it in the fourth quarter. So in some ways, this was not similar to SVB, but rather a little bit of a different kind of issue. Large bank being run pretty badly for a long time.
Siga, why are regulators acting differently? My understanding coming out of the GFC that we were meant to have one rule book for big, important, globally systemically important banks, and yet we're treating banks so differently around the world. The US is guaranteeing deposits at SVB. We've got the Swiss putting AT1s below equity. We've got the Europeans crossed with the US. We've got them crossed with the Swiss. Why are we getting these gaps in the regulatory approach? Why the different approaches being taken?
Well, Well, managing banks during good times is one thing, and the fact that we have changed the regulation for small and medium-sized banks in 2018, I think is definitely problematic. In particular, for not having them do stress tests or follow liquidity rules and do a resolution plan. Not to say that they would have been breaking those rules, but good regulation actually will support good supervision and actually even good risk management within the banks. But why we behave differently during crises, it is basically regulators looking at the balance sheets of the banks and trying to figure out how they can minimize the cost to taxpayers and also best prevent in a credible manner any kind of run on the banks. And I think for both of these sides, this was necessary. At the beginning, some regulators in the US were talking about just letting the deposits at SVB go. And that just put a new run on all medium-sized banks in the US. So, you know, they really had to do this to prevent further runs on small and medium-sized banks in the U.S.
Well, Sigurd, but how does it then play out? I mean, you take a look at what the Swiss government did with Credit Suisse and what the U.S. government did to ensure SVB depositors, etc. It just feels like governments are going to have a lot more involvement in the financial system in a very big way. Do we eventually get to some kind of like nationalism conversation? Are we going to get banks being super regulated but super boring? Like, what's the relationship now?
Well, banks should be super boring, actually. You know, as soon as we always go into non-super boring, then we get into trouble in many ways. So actually, banking is a little bit of a boring issue, and banks should just know what they have comparative advantages. It's collecting information about their customers and turning short-term liabilities into long-term assets. And that is what they should be doing. So yes, I think we're going to have that. I hope not nationalization, and I do worry about the fact that the combined banks of UBS and Credit Suisse is going to be about 2 times Swiss GDP in size. And that is not really helping that we are getting this kind of size changes.
Sigurd, do central banks know more about financial stability than the market? I ask this question because we're going to get to the Fed this week, and I want to know if the Fed goes 25 basis points or the Fed goes nothing, should I take that as a signal about what is happening within the banking system and the financial stability that we're seeing at the moment? Do central banks know more than we do?
I do hope so, that they do, and I do think they do. But at the same time, they do always look very closely at market indicators when they are considering what the systemic risk is. So, of course, they are listening to the market, taking the pulse on the market, and they do not want to spook the market either, because they know that that can amplify any kind of crisis. At the same time, I think it's pretty certain that the U.S. Federal Reserve should just consider inflation and not this small spout of bank issues in the U.S. when making the decision about interest rates this week. Definitely, if you think about it, Silicon Valley Bank was just badly run. If you cannot manage interest rate risk, that is not a good thing. And I hope, and I think most other banks in the U.S. are actually quite good at doing this. In addition to that, only 4% of the deposits were insured, which meant that their deposit base was super flighty. That just is something that, you know, is hopefully a pretty, you know, well-isolated case, and we can just move forward.
Do you think that we're going to see, though, a quick M&A cycle off of this? Whether you're looking at the big guys at UBS and Credit Suisse, or whether you're looking at other banks taking over SVB's assets, or what's happening with Signature, like, are we looking at that? And what's the consequence of rapid tie-ups like this? I don't want to be a regulator in 15 years having to deal with the fallout.
Yeah, super question. Just a super question. And in general, just this happened also after the global financial crisis. We were talking about the problem of having too big to fail. At the same time, all of the big banks just grew larger. And yes, I am superbly worried that we're going to get more mergers and acquisitions, which will end up with more large banks. And basically, we're going to end up with a system with a few number of too big to fail banks. Note, in some ways, medium-sized and small banks got themselves into this issue. By lobbying for less regulation in 2018, they are basically now losing confidence. So in some ways, they shot themselves in the leg. You know, so it's really, really important to think about this. Regulation creates confidence, and that actually hampers runs. And, you know, this is something that should be considered when you think about taking regulations of small and medium-sized banks.
Yeah, that's
do an
definitely...
LCR or liquidity regulation is super easy. It's not burdensome, and any risk management should be doing it anyways.
They'll probably say that they are, but that's a whole different story, I guess. Sigge, thanks a lot. It was really good to get your perspective. Sigge Benediktsdottir of Yale, thank you very much. All right, coming up, latest breaking news in the last half hour. Amazon laying off 9,000 more employees. Shares trim some of their initial losses. More next. This is Bloomberg.
Major resistance up here. Yeah. Horizontal is up here. Believe it or not, this already looks like it's gonna go up there. This already looks like that. So you got your key level here, signal 1, signal 2, or signal 1, signal 2, the push. So therefore, on the 5 minute, you're just waiting for a crack, something that shows weakness. So key level, key level, key level, key level, key level, push, break, then push, break, then push, entry, then lower. Then we should give this move back. However, and this is critical here, that it holds this line. By then, we're just going to be there, and I'll focus on Tesla here.
So a headline dropping onto the Bloomberg within the last half hour. Amazon is to lay off an additional 9,000 workers. CEO Andy Jassy announcing the cuts in an internal email that has been released today. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, where are the cuts coming and why are they coming?
They're coming because leaders of the company looked at the year ahead. They had strategy and planning meetings, and this is 9,000 additional cuts broadly on top of the 18,000 which they started enacting at the end of last year. So 27,000 will be the number cut all told based on this morning's announcement, which at 18,000 it was already the biggest level of layoffs in the company's history. Andy Jassy cites the uncertainty in the economy and flags a really critical point, which you and I have discussed so many times, Guy, and Alex as well. Amazon hired at really elevated levels during the pandemic era, and they're still learning that they're having to unwind that level of hiring because the economy they find themselves in now has changed.
So, Ed, we thought we were going to also see labor hoarding, and maybe in some areas of the economy we are still seeing that. I'm just wondering what tech is seeing that they're not opting for that lever.
Yeah, I mean, the two words he puts emphasis on are leaner, which kind of echoes the sentiment of what other tech companies are saying, but also uncertainty. And, you know, we go back to that metric we've discussed on the show so many times, which is Amazon at the same levels that likes of Meta and Salesforce did, hired at 100% growth 2019 through 2022. Where Amazon fell down relative to some of its peers is it added, you know, on a revenue per additional employee basis, only Meta did worse. You know, only Meta added less revenue per new employee it added. So despite the bloat, they didn't really grow the top line. Now we know both on the e-commerce side, but also the cash cows like AWS and advertising, that top line growth isn't there anymore. And that's kind of where Andy Jassy is talking about this, having had to reevaluate your teams. And that chart tells the entire story. Amazon only worse is Meta, right, in terms of the bloat and how much revenue they were able to add.
Ed, great stuff. Thank you very much indeed. Thanks for the hustle, bringing us that story. We really appreciate it. Bloomberg's Ed Ludlow joining us from San Francisco. We're kind of mid-afternoon here in Europe. It's a very different picture than the one we saw first thing this morning. We came in first thing this morning. Banks were tracking sharply lower. Names like UBS were off big on the back of that Credit Suisse deal. Since then, the situation has certainly stabilized. The Stock 600 is now up by over 1%. You do have some of the luxury names, etc., doing very well here. But you've got the banks coming back. Look at what is happening here. Banks have come back. We're now up by 1.3% on the day. The Swiss obviously not included in that. UBS tracking higher. The market is taking a much more positive view of what is happening. What is interesting, though, is that yields are continuing to push lower. We're seeing that in Germany. We're seeing that in France. France, obviously, is going to be an interesting case today. We've got a vote of confidence coming up in the French government a little bit later on. 2 votes of confidence, actually, in the French government. Keep an eye on that story. Significant rioting this weekend. Coming up, we're going to talk more about the banks. Andy Stimpson, KBW, head of European Banks Research, is going to be joining us. That conversation next. This is Bloomberg.
Now, if you truly want to learn, you're going to put in the work. If you don't expect me to put in the work for you. Don't expect me to tell you when to buy and when to sell. Don't expect me to tell you when to buy and when to sell. I have my own book. You have to, and you guys need to understand that I have my own book that I have to worry about. I have my own losses and profits that I have to worry about. And when you have your own bets like that, the last thing I need to worry about is your book. And I will tell you this. In the beginning, you should be taking more trades. Yes, I want you to lose it, but I want you to lose it slowly and learn from all your trades. Okay, let's see what they do here at this 86 level. Okay. You got someone selling it here. You got someone selling it here. Okay. This 96K, this 86 level.
Monday, March the 20th. What a weekend we have just had, but European equity markets appear to be in fine fettle. Even banking stocks are bouncing back. The second hour of Bloomberg Markets starts right now.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So here we go. European stocks are rallying into the close. We're up by 1.12%. Certainly a different picture than we saw first thing this morning, when there was a lot of fear being priced into Europe. UBS, look at that. We're up by over 2%. It was up a little bit more a little earlier on, but it's certainly significantly higher than it was at the get-go of trade this morning. The market seems to be taking a more benign view of this deal. There could be some big positives in there. One story that we maybe haven't paid enough attention to, will pay some attention to a little bit later, is what is happening in France. As you can see, yields on the 2-year, the OAT, down by 17 basis points. We've got 2 votes of no confidence coming up, Alex, in the Macron government a little bit later on. This is about this pension reform that the government is trying to push through, force through. Significant protests over the weekend. What happens if he passes those votes of no confidence, if his government passes those votes? Are we going to see a continuation of that disruption? It's hitting the French economy actually quite hard now.
Yeah, I mean, really, those pictures were stunning over the weekend in that video from all the protests. All right, the S&P is up 0.7%. I mean, honestly, I would not have expected that when futures opened yesterday at 6 p.m. And I pointed out these two banks just to show the difference, right? First Republic is still getting hit quite hard, down 12%. It's unclear whether deposit flow has actually stopped. The bank seems a little bit more optimistic, but the confidence is really wiped out when it comes to that company. But other regional banks, Western Alliance, PacWest, they're all rallying on the day. So maybe we have stemmed the tide, at least for today. Now, it feels like then we go back to steady as she goes with the bond market as well as the FX market, because you have a sell-off in the front end of the bond market here. The 2 years up 9 basis points. That feels very much in line with the Fed that's going to go on Wednesday. Maybe more like 25 basis points, even though Goldman just had a note out that says that they still see a pause happening because financial conditions have tightened. It just feels way too early, though, Guy, to kind of call the end to all the trauma. But, you know, I'm not the one in the market.
We're going to discuss that in just a moment. For now, let's take a quick view of what is happening in Brussels. We do have President Lagarde giving testimony in front of parliamentarians of the European Parliament. A couple of lines, very confident in the bank's liquidity, in European banks' liquidity and capital levels. The ECB has more ground to cover based on the current baseline. She's talking about inflation. The ECB's determination on inflation is there and is strong. As you can see, she's answering questions right now. This is what she had to say a couple of moments ago.
I welcome the swift action and the decisions taken by the Swiss authorities. These actions are instrumental for restoring orderly market conditions and ensuring financial stability. Let me also remind that we are monitoring market developments closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area.
President Lagarde speaking a few moments ago in front of the European Parliament. As I say, she's still taking questions from lawmakers. We will continue to update you on what she is saying. Let's get back to our question of the day. It was a frantic and frenetic weekend. We have, though, now seen a solution, potentially, to the Credit Suisse problem. And UBS's stock is tracking higher. We're also seeing some of the regional banks in the United States tracking higher as well. First Republic, there are some exceptions, of course, to this. So are we starting to get a handle on what is happening here? Do we still have a banking crisis? Let's kick that around. Bloomberg's Simon White and Tom Metcalf joining me on set here in London. Tom, let me start with you. You had a busy weekend. The Swiss found a way through the Credit Suisse crisis. Have they tied it off? Are we done with that part of this problem?
I think that you can probably see the light at the end of the tunnel, assuming, you know, the stock market rally we were seeing today holds. You know, it was interesting this morning. We were like, ooh, UBS shares are down. Has that fear really dissipated? It does feel as people have time to digest the deal. You know, coming back to those talking points. Credit Suisse, idiosyncratic, has lots of long-standing issues. Can you really kind of draw or extrapolate out problems, you know, across the wider financial system? I think it's still an open question, but I'm certainly feeling a lot more positive than I was at the open today.
Okay, Simon? you're my guy that talked negative, so help me understand. What are you going to say? Have we seen the end of the banking crisis?
I mean, I would say, you know, to misquote Tolstoy, you know, every banking crisis is unhappy in its own way. This isn't 2008. You know, Credit Suisse doesn't have, you know, these toxic assets on its balance sheet. It's, you know, as Tom said, it's much more idiosyncratic. But, you know, sentiment is a very kind of fickle and potentially evanescent thing. And, you know, I think you have to keep an eye on it closely. I mean, I was looking